All right, let's get right into it. The US stock market today is really a tale of two cities. You've got this powerful, tech-fueled engine pushing things higher, but at the same time, there's a wave of economic uncertainty that's threatening to pull everything right back down. So what's really driving the action here? Let's break it down.
So just look at the numbers from November 3rd. The market is sending a really clear and, frankly, a very divided message. You see the tech-heavy Nasdaq having a nice run, the S&P 500 barely squeaking out a gain, and then there's the Dow, slipping into the red. This is not a unified rally, not by a long shot. What we're seeing here is a pretty profound divergence.
And this isn't just about the numbers themselves, right? It's about the why behind them. What we're witnessing is a classic battle. On one side, you have this formidable growth engine, mostly powered by tech, and on the other, a set of very real economic risks that are weighing heavily on pretty much the rest of the market.
Okay, so let's start with the positive side of the ledger. What is fueling all this optimism? We're going to look at four key factors that are giving the market its upward momentum and creating these pockets of, well, extreme strength.
The number one driver, and this should surprise no one, is the absolutely relentless corporate spending in artificial intelligence. We're talking about a massive capital investment cycle that's directly lifting the stocks of any company at the center of this huge technological buildout.
And you can see this spending is translating directly to the bottom line. I mean, just look at this. With over 80% of S&P 500 companies beating their Q3 earnings expectations. That's some serious fundamental support for higher stock prices, especially in the tech sector.
Next up, you guessed it, monetary policy. The Fed's decision to cut interest rates makes capital cheaper. And what does that do? Well, it encourages more corporate investment, and it makes stocks look way more attractive compared to lower-yielding bonds. It's a double whammy for investors.
And finally, we've seen a bit of a thaw in geopolitical tensions, thanks to the recent trade agreement between the US and China. You know, just removing that layer of uncertainty lets investors get back to focusing on company fundamentals, which is always a clear positive for the market.
But listen, that's only half the story. Now we have to look at the other side, the serious pressures working against this rally. These are the things that, as an investor, you simply cannot afford to ignore.
And this slide. This visualizes the core conflict just perfectly. It's a real tug of war. On one side, you've got those powerful tailwinds we just talked about, but on the other, you've got a set of very real risks that explain exactly why the Dow is struggling and why so many other sectors are just getting left behind.
So first on the risk list is concentration. This rally lacks breadth, okay? A huge, and I mean huge, portion of the market's gains are being driven by just a handful of those AI-related mega-cap stocks. Whenever you see so few names doing all the heavy lifting, it creates potential instability for the whole market.
And if you look beyond the tech bubble, signals from the broader economy are flashing yellow. We're seeing a weaker manufacturing survey, the labor market is starting to soften, and there's a pretty notable increase in credit risks bubbling up in commercial real estate. These are, the classic signs of a potential economic slowdown.
The thing is, this division isn't just theoretical. You can see it playing out in real time when you look at individual stocks. The gap between the market's winners and losers, well, it's becoming a chasm.
Just take a look at these extreme movers. You've got Cipher mining, tied to that speculative tech and crypto space, absolutely soaring. And then on the flip side, an industrial staple like DuPont is down over 50%. That reflects some really deep concerns about the core economy. Even inside tech, look at Nvidia's solid gain. It's completely dwarfed by the total collapse of biotech firm Uniger. This right here is the divided market in action.
So what does this all mean for you as an investor? In this kind of complex environment, where should your focus really be moving forward?
These are the critical data points you need to be watching. The next round of tech earnings will really test the foundation of this rally. Every single signal from the Fed on future policy is going to be scrutinized. We have to watch the flow of capital into AI to see if that engine is still firing on all cylinders, and of course, any shift in US-China relations could change the whole game. These factors are what will likely determine the market's next big move. So here's the ultimate takeaway. We are not in a market where a rising tide lifts all boats. That is not what's happening. The broad index numbers are hiding a much more complicated reality. To succeed here, you've got to move beyond just passively tracking an index and really focus on targeted, data-driven analysis. This is a market where conviction in your research is everything. So do your homework, understand the fundamentals, and be prepared to navigate a market that's more divided than ever.